Should you buy long-term care insurance, or is it better to self-insure? It's one of the most personal financial decisions many retirees face. Hi, I'm Mike Eatwall, founder and CEO of the Dalla Group, a wealth management firm focused on helping retirees. In this video, I'll walk you through the pros and cons of long-term care insurance, the alternatives that exist, and how to think through what's right for you. Let's start with why this topic matters so much. Roughly 70% of people age 65 and older will need some form of long-term care at some point, whether that's home health care, assisted living, or memory care. And the costs can be significant. Home care averages around $30 an hour. Assisted living typically runs $5,000 to $7,000 a month. And memory care can be $8,000 to $12,000 or more each month. Most of those costs aren't covered by Medicare. And if you don't have a plan, you could end up selling investments or property under pressure. So let's talk about the two main types of long-term care insurance: traditional long-term care and hybrid long-term care. We will start with traditional long-term care. These policies used to be much more common 15 or 20 years ago. They work a lot like homeowners insurance. You pay a premium, and if you need care later, you file a claim for benefits. If you never need care, the premiums stay with the insurance company. Today, far fewer companies still offer these policies, and premiums have gone up. But they do provide some valuable features, such as dedicated coverage, inflation protection riders, monthly benefit limits, and potential asset protection if you ever need Medicaid support later. Coverage details can vary by policy, so it's important to review exactly what's included and how benefits are triggered. That said, we are seeing fewer people purchase traditional policies today, and more look toward flexible alternatives that include guaranteed benefits. One of the most popular alternatives is what's known as a hybrid policy, a combination of life insurance with a long-term care rider. So here's how it works. You pay a lump sum, often $100,000 or more per person, or you pay a structured premium over several years. If you need long-term care, the policy provides a pool of benefits you can draw from. If you never need care, your beneficiaries receive a life insurance death benefit, typically equal to or slightly more than the initial premium you paid. Many of these policies also offer a return of premium option, meaning if you cancel, you can get your money back. They're not always cheaper, but they are more predictable, with no surprise rate increases, and they can fit nicely into estate or legacy planning. For people who want to know their premiums won't disappear if they stay healthy, hybrids can be very appealing. Besides using a long-term care insurance policy, we also need to consider the strategy of self-insuring. For higher net worth families, self-insuring can absolutely work, but it needs to be intentional. It doesn't mean just saying, we'll pay out of pocket if it happens. It means actually running the numbers. What would a worst-case scenario look like? Would long-term care costs derail your retirement plan? Would you have to sell investments during a market downturn? And would your spouse or heirs be negatively impacted? Self-insuring works best when it's deliberate. Now, let's look at a few examples of how this plays out. Paul is 68 and Lynn is 65. Together, their net worth is about $4.5 million, mostly in IRAs and a brokerage account. They're in good health, but Paul's family has a history of Parkinson's. Their concern wasn't running out of money. It was protecting the healthy spouse if one of them needed care for several years. They considered self-insuring, but worried about having to sell assets during a market downturn. We modeled their situation and found that a joint hybrid life and long-term care policy could provide balance. They used $250,000 from their brokerage account to fund the policy, which provided about $6,500 per month each for up to 5 years of care, plus a death benefit if they never used it. It preserved their main portfolio for lifestyle and legacy and gave them peace of mind that a portion of their long-term care expenses would be covered by insurance. In another scenario, Danielle is 70, single, with a net worth around $3 million, including IRAs, a brokerage account, and 2 homes. She didn't want to go through medical underwriting, so she initially planned to self-insure, but without any real structure behind it. We stress tested her plan with several care scenarios. Her plan held up well. We adjusted a small piece of her portfolio to make sure those funds were liquid and not tied up in volatile assets. That structure turned a vague idea, I'll self-insure, into a real intentional strategy. So, how do you decide what's right for you? At the Dollar Group, we help families evaluate this using real numbers, not averages or industry assumptions. The goal isn't to insure everything, it's to reduce the risk of financial disruption later in life. If you found this information helpful, please give this video a thumbs up and subscribe for more financial insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwall, founder and CEO of the Dollar Group. If you are interested in seeing how we help our clients, visit us at www.thedollargroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.